Hello, everybody, and welcome to our show today. So today we're going to decode business credit scoring, and I'm really glad everybody could make it because this is extremely valuable. This is extremely important. I'm a big proponent that if you know how things work, it's easier for you to control those things. And in this case, there's probably not much more important than your business credit scores, because your business credit scores ultimately will determine if you get approved for a loan, how much of a loan you'll be approved for, even the rate and term that you'll pay on the actual loans that you secure. So a lot of benefits by knowing exactly what your business credit scores are, how they work. And that's what we're going to be diving into today. We're going to decode this whole thing. We're going to look at a lot of different credit scores that are provided or that are offered through Dun & Bradstreet, Equifax, and Experian. And this way, you actually know how these scores work and know how to actually control them. Now, for those of you that don't know me, my name is Ty Crandall. I am the CEO here at Credit Suite, and what we do is we help customers build business credit. We help with all aspects of obtaining credit for a business EIN that's not linked to a Social Security number. So all we do is build business credit. We know a lot about business credit, a lot about business credit scoring. There's not going to be any kind of pitch or any kind of sale taking place on today's webinar. All we're going to do is just go for about an hour plus and talk straight information about building business credit, or not about building business credit, but about how the credit scores work when it comes to building business credit. And if anywhere along the line you want to grab a free guide on business credit building, then check it out, creditsuite.com/EIN to do so. So your business has its own credit profile and score that's linked to your business EIN number. There are three main business reporting agencies that are involved with credit scoring for businesses. This is Dun & Bradstreet, Experian, and Equifax Commercial. Look, the reality is this is the ones in the United States. Business credit is a worldwide concept. There's a lot of countries, even Australia, for example, where they build business credit. They just oftentimes work with different reporting agencies than we do here in the States. But in the States, you're usually dealing with Equifax, Dun & Bradstreet, and Experian. And a business credit score, what we're talking about, the basis of it, is basically a mathematical model that's used to depict a business's risk of going 90 days late on an account within the next 12 months. So if I look at the definition of a business credit score, it's exactly the same as a consumer score, but a consumer credit score depicts a consumer's risk of going 90 days late on an account within the next 24 months. So a little bit of a difference right off the bat is business credit scoring. We're typically trying to determine, is this person going to default in the next year or not? And a consumer credit score, they're looking to see if you have a risk of defaulting over the next 2 years or not. Now, a business credit score reflects your business's likelihood of defaulting on an obligation, not you as the business owner's obligation. And the business credit score is based on how the business obligations are paid, not how the business owner pays their personal obligations. And if you are looking, I'm not sure if on all my slides, my virtual assistant Sarah put this really cool thing here that says credit score 702. Most business credit scores, as you'll learn, go from about 0 to 100. So we're going to act like that's like a SIR rating or something that fits within that range, because I think she grabbed that for a consumer credit score. So each reporting agency provides access to multiple business credit score that evaluates different forms of risk. FICO also provides its own business credit score to assess business risk, and banks have their own internal credit score as well that's used to determine business loan approval. So this is a little different. Most lenders nowadays use a FICO consumer credit score when they're determining approval or denial for somebody on the consumer side. In the business side, you're usually using a credit score that's created by the business reporting agency. FICO does have a score that's used in the business world, but it's not the primary score that a lot of lenders and credit issuers are looking at. They're usually using one of the bureau's own scores, which is not like what we see in the consumer world. Now, all these scores are used by credit issuers, lenders, suppliers, vendors, and others who typically want to extend credit to businesses. So the bottom line is, if you ever want to get money or credit to fund your business, well, These are important because these credit scores will literally depict how much you get approved for, if you get approved, and the rates and terms that you'll pay. So yes, your business credit scores are used each and every time you apply for credit, but lenders and credit issuers will not tell you this, nor tell you which scores they're using to access your or to assess your business. There's no Fair Credit Reporting Act in the business world that requires them to do so. So we're used to this, and this is something that a lot of people run into. In the consumer world, if you applied for a loan and got denied, they have to, according to the Fair Credit Reporting Act, send you a letter by mail that notifies you which bureau they pulled to make the lending decision and why they denied you. There's no rule like that in the business world. There's no law that governs it. So every time you apply for a business credit card or business loan, they are pulling your business credit scores, and your scores are being used to determine approval or denial. But they'll never tell you this. They'll never send you that letter and tell you they did it because they're not required by law to do so. The reason I tell you this is because a lot of people have their business credit scores used. They don't have business credit established. Their scores are low as a result. And they think that they don't know why they got denied. They think it's because of something else, because they don't realize that their business credit scores were even used to assess their risk. But they are. You need to know every time you apply for a credit card or loan, they absolutely are being used. It's just, again, they don't have to by law tell you this, so they oftentimes are not. And I'm probably not going to have much time to answer questions until the end, but I did get a question here. Are there inquiries that are counted on business credit? Yes, business credit does count as inquiries. It does actually show on reports, but it does not calculate into the scores. As we'll go through the scores in a little bit, I'll give you more detail. So inquiries show on reports, but they don't calculate the scores like they account for 10% of consumer scores. So it's also important to note that your business credit profile and scores are available to anybody who wants them. So in the consumer world, we're not used to this, right? Like, I can't get mad at you and go pull your consumer credit report to see what I can learn. I can't do that. That's like against the law, because the Fair Credit Reporting Act says that I have to have permissible purpose to do it. But remember, there's no Fair Credit Reporting Act in the business world. So anybody who wants to get your reports can easily and cheaply do so. As a matter of fact, if you go to Dun & Bradstreet's website, they even give you some options. They say, do you want to pull your own business credit reports? It's like $200 a month. Do you want to pull another business's credit reports? It's like this much per report. So you can easily obtain information, and anybody can get your information and scores anytime they want it. It doesn't need to be a lender or a supplier. It could be a competitor. It could be your prospects, your clients, your business partners. It could be somebody looking to invest in your business. You need to know this is public information that anybody can obtain. It's not just something that is reserved for lenders, credit issuers, vendors. So Dun & Bradstreet, let's take a look at Dun & Bradstreet's credit scores and how their multiple credit scores actually work and are calculated. So Dun & Bradstreet is the biggest business credit reporting agency if you're not familiar with them. They have been around since 1841, guys. A lot of people think that somehow business credit is a new concept. The reality is Dun & Bradstreet was around 70 years before the first consumer credit reporting agency. So business credit's been around 70 years longer than consumer credit's been around for, and Dun & Bradstreet has been the oldest reporting agency that's really even known to exist. Now, they provide two performance-based credit scores. Now, if you're not sure what these are, basically performance scores reflect your past performance using only information within the D&B database. So they get information from suppliers and credit issuers and trade vendors. These companies report your payment history to D&B, and D&B provides two performance scores that are based on your prior performance of paying your bills. So these two scores are your PAYDEX score, and also one that you could easily control some aspects of, which is called the D&B rating. So the PAYDEX score indicates how you pay your bills over the last 24 months. The D&B rating indicates a company's net worth range based on your company financial statements, as well as a company's overall conditions, okay? So when we're talking about a D&B rating has to do with your net worth. It takes into account your financial information, whereas a PAYDEX score is just looking at your overall payment history. So the PAYDEX PAYDEX score is the most popular credit score in the business world, not just with DMB, but overall it is the most common score that most people are familiar with. From DMB, the DMB PAYDEX score is DMB's unique dollar-weighted numerical indicator of how a firm paid its bills over the last year based on the trade experiences reported to DMB by various vendors. So they just told you what I just said. Basically, the PAYDEX is made up of the payments, the trade experiences that they have on file from the people that reported them, or what they're actually defining here as vendors. That is how your PAYDEX score is calculated, or that's what your PAYDEX score is. Now let's dive in a little bit deeper to what this means. Well, dollar weighted means that DMB gives more weight to accounts with higher limits than accounts with lower limits. So PAYDEX gives more weight to trade accounts that report higher amounts of credit extended and less weight to trade accounts that are reporting lower dollar amounts of credit. The bottom line is, if you ever need to go late on an account that reports to DMB, you're better off to go with the lower limit account than the higher limit account. The higher limit accounts, or the more credit you're issued, the higher the limits, the more that calculates into your overall score. So if we've got two scores, we've got two accounts. You paid one on time and you paid one late. Well, you know, they might not have equal weight in your score. What's going to have more weight in your score is which one of those two accounts had the actual higher limit. That's what dollar weighted means when we talk about PAYDEX score. Now, how a firm paid its bills over the last year, that part of their definition, means the score, again, is based on past performance as the driver. It's simply based on how you paid your bills. The score ranges from 1 to 100. Higher scores are lower risk as they predict better payment performance. So let's look at this. A PAYDEX score basically goes from 1 to 100. 100 scores the highest you can get. This is why I love building business credit, and why you should love building business credit too. Okay, somebody actually asked a little bit earlier. Lori asked. She said, hey, do inquiries calculate into this score? No, they don't. This is what's beautiful about business credit scores. You see, consumer credit scores take into account payment history, utilization, length of credit, the new credit you have, the credit mix you have. All these things affect your score. So even if you pay your bills perfectly, you could still have a low score because you don't have the right credit mix, or you applied for too much credit, or you're overutilizing your credit card accounts. Not with PAYDEX. PAYDEX is very simple. If you pay your bills on time or early, you'll get a good score. If you pay your bills late, how low your score goes depends on how late you pay the bill. So this is very easy to control. All you have to do to get an excellent score with DMB through their PAYDEX is get some accounts that report to DMB and pay the bills as agreed. If you've done that, you get a good score. It's much easier to get good scores than it is in the consumer world, which is why it's so much easier to get business credit and to get money in the business world, because it's so easy to access good scores and build a good profile. So any score of 70 and higher is defined as good per DMB. An 80 score reflects that you pay your bills as agreed, or you paid promptly. A score of 70 means that you pay about 15 days within the term, so about 15 days late. So if you pay your bills on time or within 15 days late or early, you're typically pretty good per DMB. Now, some credit issuers will not approve you unless your PAYDEX is a 75 or 80. So the bottom line, try to always pay your bill on time or early. I always advise clients, as soon as you get an invoice, pay the bill. Don't pay it before you get the invoice. Pay it when you get the invoice, and you'll always have a good score. Okay, a score of 50 represents that you're paying about 30 days late. So a business can obtain a good PAYDEX score by just simply ensuring you pay your bills. As long as you pay your bills that report to DMB on time, you'll have a good score. Keep in mind, most utility companies don't report in a lot of cases. Most suppliers, vendors, credit issuers you deal with, a lot of people don't report to the reporting agencies. I like to say that building business credit is very intentional. You know, in the consumer world, if you go get any credit, it almost all reports to the consumer reporting agencies. So as a result of that, you know, you just used to credit scores being established, a credit profile being established. But in the business credit world, that's not the case. What is the case is that a lot of accounts don't report, so you have to be conscious of who reports to DMB and who doesn't, and pay those bills as agreed to get a good score. So here's exactly, and my columns are a little bit off here, but you can still see that this is exactly how PAYDEX works. 100 score means your payment's going to come early. 90 means that payments come within the early discount period, and an 80 score means your payments paid on time. Okay, if you were 14 days late, you have about 70 score. Okay, if you were 90 days late, you'd have a 30 score. Your score literally depicts how you pay your bills. This is why I love business credit, because it's easy to get good scores. You get accounts that report, you pay the bills, you get good scores. There's not all this convoluted mess that the consumer FICO has, where your credit mix and how long you've had credit and your utilization and all these things calculated into the score. Again, it's why it's so easy for you to be able to build business credit quickly. Now, a business will need a PAYDEX of 70 to 80 to obtain most favorable financing terms. To obtain a PAYDEX score, a business needs to have 3 trade lines reporting to DMB, and it can take about 30 to 90 days for those trades to report and a score to be established. A lot of people ask me this, a lot of people. Ty, I got a DMB, I got an account. I got a couple accounts to report to DMB. Why aren't I being issued a score? That's exactly why, those 2 reasons. You need 3 accounts to get a score, and you got to give them time to report. Sometimes some, like Quill, only report every quarter. So if you get a Quill account and use it, they're not going to even report it for 3 months. So again, some take up to 90 days to report because they only do report quarterly, and you've got to have 3 accounts before DMB will give you a score. So if you've got some accounts you think are reporting to DMB and you don't have a score, it's probably because you haven't given them enough time, or it also can be because you don't have the necessary 3 accounts you need to get reported. And the score is calculated by using a ton of different payments, 875 different payments calculated into the score. You'll never need to know that, okay, because the very biggest of big companies might actually have this many payments, where some don't even calculate the score, they have so many, but more than likely you and I are never going to have more than 875 accounts reporting. So the true definition of the DMB rating, now that we've talked about PAYDEX, DMB rating is a performance score based on a company's net worth from its financial statements, as well as an overall credit assessment using information in DMB's database. So the DMB rating basically indicates a company's net worth range based on your financial statements, as well as a company's overall financial condition. If a company's financial statements are not provided, the score is based on your size, your industry, and other related factors instead. And we'll break this down. So the DMB rating is a performance score that's based on a company's net worth and overall credit assessment. The DMB rating is basically broken into 3 categories, and these are all ones you can control, as I'm going to show you here. A category is assigned based on the amount of information available for your company. Category 1, traditional DMB rating. 2 is expanded credit appraisal, and 3 is alternative ratings. Now, this might not mean anything to you yet, but I'm about to show you why it will. This is a pretty cool score that DMB provides because you can control it. You can decide what category you're in depending on whether or not you want to give them your financials or you don't. Now, if they can get your financials and if they have access to your financials, then you know, you're good. They're going to fit into category 1. But if not, well, then you could supply it and actually move yourself from one category to another one. So traditional DMB rating of that category 1 reflects your net worth or equity. They calculate it based on your financial statements and the payment experiences they have on file. So this is the second time payment experiences has come up and I haven't defined it for you. A payment experience is a trade line. It's an account that reports to them. That's what they refer to as payment experiences. So if I go get an account with Quill, Uline, and Seton before Seton stopped reporting, and all 3 of those reported to DMB, which they don't, but let's say they did, then that would give me 3 payment experiences with DMB. If I only had Quill and Uline reporting to DMB, that would be 2 payment experiences. So a payment experience is the reporting of an account or a trade line to DMB. So they calculate this based on your financial statements, your companies, your tax returns, and your payment experiences. Both must be on the report to qualify for this traditional bank rating. So to be in a category 1, basically where DMB is telling vendors and credit issuers and lenders, we know a lot about this company because we have, 1, trade experiences. They've got companies that are they're paying as agreed or not that are reporting to us the payment history, and 2, we have their financials, we have their tax returns, we know the revenues, the profits, and etc. that they're generating. So we have a pretty good guess of where their DMB rating should be because we have both factors we need to be able to calculate that rating. Even if you have payment experiences, if no financials are present, there will be no traditional DMB rating. I get this question. Why don't I have that rating? You don't have the rating because they don't have your tax returns. Well, I have accounts reporting. You have half the equation. If you have accounts reporting to them of 3 or more, well, then they have the payment experiences for that part of a category 1 aspect of your DMB rating. But without your financials, you can't fit into that category where they say they have enough information to make a good decision. Now, the score also includes this composite credit appraisal score. Now, this reflects an overall assessment of creditworthiness based on a company's payments and financial stability. And I'll tell you a little bit more about that in an example. So if financials are not available for a company, well, then you fall into this category. So let's say you have payment experiences, but you don't have tax returns. They don't have your tax returns. Well, then you'd fit into that category 2, which is basically going to make the determination based on the number of employees you have for your business. Man, I got to tell you, this stuff is so important and people don't understand why. When I talk to people about business credit, even before I came on this webinar, somebody responded to one of our ads on Facebook and said, hey, how do I go into my bank and get a loan based on business credit? This is where people really get lost with business credit. Business credit reports reflect more than just your payment experiences. They report your creditors, the ones you pay, whether you pay them on time or not, or how you pay, and they determine all those things to do with your payments. But they also show your company's size. How much do you generate in revenue? How much you generate in profit? They also show your employees. They show your industry. And all these things factor in. So even though these things don't matter in your PAYDEX score, they don't matter, right? All of it matters in your PAYDEX score is payment history. When it comes to DMB's second most common score, their DMB rating, what they're doing here is they're saying it does matter. How big your company is, the financial stability of your company does matter. It's a determining factor of the DMB rating. So think of it like this. This is very different than what you and I are used to with consumer credit scoring, right? With consumer credit scoring, we're used to all these different factors being in one score. In the business world, that's not the case. You have many different scores, and each score is used for a different reason. So the PAYDEX score, in large part, is used for, credit issuing, for issuing credit cards, for example. So if you pay your bills as agreed, you get a good score. It's easy to get high limit revolving business credit card accounts with no personal guarantee and no personal credit check from you. It's easy to do. It's very easy to do if you know the steps to do it. But it's harder to get bank loans, because bank loans take into account your PAYDEX and your DMB rating. So now banks say, well, look, we don't just care about whether the guy pays his bills on time or not, because let's be honest, he could get 5 accounts, pay him as agreed with $100 limits and get a good score. We know that, you know that. We're lending him $100,000. We care more about other things too. We need their financial stuff to be included as well. So we want a DMB rating. Well, with the DMB rating, now they say, okay, DMB goes, okay, listen, Mr. Lender, we can tell you how stable they are because we have their tax returns and we know. We've seen their payment experiences and we have their tax returns. They're in a category 1, here's their rating. Or DMB might say, well, look, here's the deal. We don't have their tax returns. We don't have their financials. So since we don't have the financials, we still have the payment experiences. We're going to have to guess on how stable they are financially based on the only information we have, which is employees. What's the number of employees they have in their business? They get this from your Secretary of State. Every year you file an annual report with your Secretary of State, and remember, they ask you, How many employees do you have in your business? So the number you put there has things to do with taxes, and it also ties in right here to your DMB rating. DMB gets the information from the Secretary of State. They know how many employees you are, and they make a guesstimate of your financial stability based on how many employees you have. Are you a startup or are you a big company? Now, if you have payment experiences and 10, 20, 30, 40 employees, well, if you got 40 employees, they're giving you the benefit of the doubt that you're more stable and giving you an improvement in this category. They're putting you into this category too. Okay, now, if nothing's available, if they don't have your tax returns, they don't have your financials, they don't know your size, they don't know the number of employees, meaning maybe it's your first year in business, you haven't supplied your annual report with the Secretary of State, well then DMB gives a score in this third category, the alternative ratings category, based on the amount of information available on the company's report, based on what they can actually get. Okay, so again, that's how this DMB rating works. Think of it again like this. The consumer credit scores take a bunch of different factors into account in one score. In the business world, the scores really reflect only one thing. There's just multiple scores. This is why if you ever pull a DMB credit report, you'll see 3, 4, 5 scores on there because they all reflect different things. Your DMB rating has to do with your financials. If you have good financials, then you want to make sure you get into DMB to get in category 1. If they're not so good, well then again, be very careful when you put the number of employees on your Secretary of State annual reports, because that ties into many things, taxes, etc., but it also will bring it right over here. And if they don't have any of that, they're going to put you in a higher risk category, which is going to make it harder to get a bank loan. This is exactly why I was saying that a lot of people think that just because you build business credit, you're going to be able to immediately get a loan. That's not the case, because if you're in a high-risk category with your rating where they say, look, man, we don't even know who this guy is. We don't have payment experiences, nor do we have any financial data on him. Well, then lenders are like, we're not going to probably lend to somebody in this category 3 because guess what? They don't have any payment experiences. They don't have tax returns submitted. They don't have annual reports probably submitted, so they're higher risk. And this is why more factors than just your PAYDEX score come into effect when it comes time to start getting bank loans. So DMB's predictive scores predict the company's expected performance over the next 12 years or 12-month period. So remember, we just talked about the 2 performance scores, right? How you performed in the past. Now we're going to get into some guessing. Now we're going to get into prediction. And DMB has 3 scores to predict. DMB delinquency predictor score, the financial stress score, and the SIR rating, the supplier evaluation risk rating. Okay, now the DMB delinquency predictor score predicts whether a business will pay its bills on time. Financial stress score predicts the chance that you're going to experience financial distress, i.e. bankruptcy. You're going to close your doors. And the SIR rating predicts whether a business will stop delivering its goods and services, right? So the supplier, the SIR rating really is very much meant for people that are dealing with suppliers, right? That's where they mostly care about it. Are you going to stop delivering your goods and services? Is somebody at risk of paying you money and not getting their goods and services? If you're not a supplier, you don't even really care about that to begin with. You're not working with suppliers or supplier. Financial stress, each reporting agency has one of these we're going to see by a different name. Are you going to go BK or not? Are you going to close your door? Are you facing imminent closure of your business because your business has failed? And then the delinquency predictor, which is kind of a variant of PAYDEX, which predicts whether you're going to pay your bills on time or whether or not it doesn't. So I'm not going to dive in depth to those 3, but that's what we're talking about. The SIR rating predicts whether you're going to keep delivering your goods and services. It's used for suppliers to know whether or not they should, or whether or not people should pay you and expect to get the product or service on time. Financial stress score, are you going to go BK and shut your doors or are you not? Delinquency predictor, very similar to PAYDEX score. It's just, again, it's not performance-based, it's predictive. It's another thing, that another tool banks and credit issuers can look at to further predict whether or not you're going to pay your bills. So basically, they have two ways. They look at what you've done in the past in your PAYDEX score. They look at what D&B predicts you'll do based on all the hundreds of millions of businesses that they have on file, and that gives them a pretty good idea of whether or not you're going to pay your bills on time or not, especially if they start accumulating and looking at multiple of these actual credit score. So let's take a look now at Experian's business credit scores. Okay, now that we've looked at D&B, the biggest reporting agency, let's now dive in and take a look at the second biggest reporting agency's scores as well. So the second most popular credit score in the world is Business Experian's INTELLISCORE. And Experian's most recent score is called INTELLISCORE Plus, which they boost as the next level in credit scoring. INTELLISCORE Plus takes into account hundreds of variables, and they also give you a score of 0 to 100, much like we saw with PAYDEX. And INTELLISCORE predicts a business's risk of going seriously delinquent over 90 days late, okay, such as a bankruptcy within the next 12 months time period. Okay, so that's INTELLISCORE. Now, the INTELLISCORE Plus is over 800 aggravates or factors that affect the scores. Experian first takes a business and looks at data segments such as firmographics, public records, collections, trade information, and then places each business into one of 3 different models. So INTELLISCORE is only one, or is one of the only business credit score that offers a blended score. That is not blender score, it's actually a blended score. The blended owner model blends both your commercial and your consumer together. So this is pretty good. For the most part, most of your business credit scores do not take into account anything to do with your consumer credit scoring history. None of what we saw with D&B, none of what we'll see with EQUIFAX do, and only one of the INTELLISCORE different options even takes this into account, but you need to know about it. And so does FICO SBSS. I'm not sure if we'll cover that today. I'm probably sure we probably will. Because the score blends with consumer data, this is one of the only scores that someone needs your permission to pull. So that's the great news, right? I already told you that whenever you apply for credit or loans, that they're pulling your business credit report and they don't ever need to tell you, they don't need your permission to do so. The great news about this blended model is that if a lender or credit issuer ever does use it, they have to have your signature and permission to pull your credit score because your consumer credit's taken into account. And guys, this is really one of the biggest reasons that consumer credit scores are not part of most business credit scores. And for the record, just so you don't get confused, all of INTELLISCORE options don't take into account this. This is one of INTELLISCORE's options called a blended score. Most credit issuers and lenders don't use a blended score because they have to have your permission to pull it, and they don't want your permission. They want to just pull your business credit reports and scores, which they can do with EQUIFAX, D&B, and all of Experian's scores outside of the blended score. So it's not actually really common. Even though Experian brags about it and says it's the best way to predict risk to look at you on the consumer side and the business side, most lenders and credit issuers just simply do not look at this because they don't want to have to get your permission to do so, and most business scores reflect your risk without them actually needing to look at your consumer credit scores. So studies showed from Experian that when trouble hit a business, blended scores dropped on average of 30% over the 4 quarters leading up to the bad event. Their consumer scores of the owner showed no statistically significant decline over the same period. The score evaluates the personal information on owner as it relates to business performance. So the bottom line is, what Experian says is, hey, look, our blended scores dropped the quarters before the problem occurred, and if we just looked at the business or the consumer scores without them together, neither one of them really showed any variant. So Experian uses this as the basis of why people should use the blended score, but again, it's not very widely used. This is just not something you're going to run into often in the business world. And Experian says that research data indicates that 53% of problems for a business revealed their first sign of credit problems on the business report. 46 of the problems first showed on the consumer's credit report, and they said that blended scores outperform consumer or business alone by 10 to 20%. I believe this. I do. Because if they have your credit, your scores as a consumer, and your business's scores, they're probably more accurately going to be able to depict your risk if they only had one or the other. But again, a lot of consumers don't want their credit pulled when they're applying for business credit or business obligations. That's why they build their business credit. And so as a result, it's not widely used as much as Experian brags that it should be widely used. So INTELLISCORE Plus, just like FICO, has multiple facets to the entire score makeup. There's actually 5 different components of the score. Now keep in mind that the blended score is one variant of INTELLISCORE. There's multiple models that somebody can pull, a lender or credit issuer, trade credit or trade vendor or supplier. There's multiple models they can pull. They usually do not pull the blended model because it requires your permission, and they don't want to get your permission, and they don't want to look at your consumer credit to begin with. So I wanted to talk about it, but keep in mind, most common uses of INTELLISCORE by credit issuers and lenders do not take into account your personal credit. Almost no business credit does, except for that one variant of INTELLISCORE, which is the blended score, something you'll rarely run into. But if we look at the other variants, the ones that are commonly used by credit issuers that do not take into account your personal credit, they're usually based on 5 factors, and here they are. Your historical payment behavior is 5 to 10% of your INTELLISCORE. Your age, the industry you're in, and the size of your company is 5 to 10%. Your credit utilization is 10 to 15%. Derogatory items are 10 to 15%. The payments and balances are 50 to 60% of INTELLISCORE. So, much like FICO and unlike PAYDEX, INTELLISCORE has 5 factors that calculate into the score, not just one. But here's what's interesting. If you look at this, historical behavior has to do with your payment history, right? Historical behavior payment. That's what they're talking about. Historical behavior. Do you pay your bills on time or late? Derogatory items has to do with how you pay your bills. Payments and balances has to do with how you pay your bills. So when you look at this, the only 2 factors that don't deal with how you pay your bills is the age, industry, size, and credit utilization, which accounts for 15 to 35% of the total score. And the other part of the score, the other 70 to 80%, or actually more, 60, 70% to 75, 90, 85%, has to do with payment history. The bottom line is, most of your INTELLISCORE is based on how you pay your bills as well. Up to about 85% of the score has to do with how you pay your bills. Very little of it has to do with anything else. So what it does have to do with is utilization, utilizing your accounts, how you utilize them, and the age, industry, and size, which is only 5 to 10% of your score. Bottom line, as long as you pay your bills early or on time, you're going to get a good INTELLISCORE as well, even if you are in a high-risk industry or aren't that big. So even though it is made up of 5 factors, 3 of those 5 directly relate to payment performance or how you pay your bills, and those 3 account for upwards of 85% of your overall credit score. So scores are based on a number of factors that combine on your business report, the number of experiences you have, the outstanding balances, how you pay your bills, your habits, your utilization, trends over time, public record info, demographics such as years on file. This is actually pretty important because Experian, I think I might talk about this later, so I might not even dive into this, but Experian is one of these weird reporting agencies that will give you a low score even if you have no credit reporting with them. And this is why I'm glad that you're here watching this and listening to this today, because I see this all the time. And I play this, I don't want to call it a game, but what we do is on Periscope and Facebook Live, I pull business credit reports. And I have people tell me what they want, their business name and their address. We pull the report to review it live on Periscope, Facebook, of course, with their permission. Not that I need their permission, but I get their permission. We review it together. I give them tips on improving it. And I can always guess that somebody has no report information if they have a 27 to 29 score, because Experian will give you a 27 to 29 score, a failing business credit score, because they have this last one I mentioned, demographic info. They know you exist, and because they know you exist, they can automatically give you a low score even when you have no credit established. So the INTELLISCORE is calculated by a statistically derived algorithm designed to determine risk based on multiple factors. Credit, and this is from Experian exactly. Number of trade experiences, balances outstanding, payment habits, credit utilization, and trends over time. So let's look at this. number of trade experiences. Okay, your score is calculated and in large part can be weighted based on the number of trades you have, the balances that you owe in relation to the credit limits, which is the same as credit utilization, your payment habits and your trends, i.e. how you pay your bills. Do you pay on time or do you pay late? Public records, recency, how recent are they? How frequently are you getting things like judgments, lawsuits, etc. that might show there? And the dollar amount associated with liens, judgments, bankruptcies, any other kind of public record. Actually, I didn't mean to mention lawsuits there. It is on the report, but not here. Demographic info, years on file, your SIC code and business size. So let's look at this for a second. So demographic information alone can get you a credit score with Experian. It's a failing score. It will get you denied for business loans. It will get you denied for business credit. It will get you denied for a lot of stuff just because they have your demographic info. Well, what does that mean? Well, it means that you've got some kind of profile established with them. They know what industry you're in, or they know how many employees you have, which could just mean that you filed your annual report with the Secretary of State. Guys, bottom line is, you get in business more than a year, if you don't build your business credit, you're going to have some problems. Because what's going to happen is, even if you slid by and nobody that gives Experian data has given them data about you yet, which will be hard to do, but let's say you did it, then more than likely you're going to file annual reports for your Secretary of State. Experian will get that data, populate a report, give you a low score just because they know one of these factors about your demographic info, even if they don't know anything about your credit or your public records, which gets to be a problem. Experian also offers a financial stability risk score. This score predicts the potential of a business going bankrupt or defaulting on its obligations. FSR scores range from 1 to 100, and they are broken down into 5 risk classes, with class 1 being the lowest risk. So here they are. A score of 66 to 100, risk 1, 31 to 65, you can see this. 11 to 30, risk 3, 4 to 10 is risk 4, 1 to 3 score is risk 5. And this really shows their scoring statistics of bad pay history, basically. So if you're risk 1 and you're low risk, well then, the default risk of people that are in that 1 is less than 1%, about 0.5%. And you can see it climbs all the way to the higher risk people that have a score of 1 to 3 show a 36% default rate. So, I mean, those people are defaulting very, very, very often versus the people that are in the lower risk. So the bottom line is Equifax, Experian, and D&B all have this, and they're looking at how you pay your bills, are tying in all these factors to determine whether or not there's a good risk of your business going out of business, not having a lot of employees, not having a lot of age, not having a lot of trade lines, not having things paid as agreed, all calculate into this. So I hope you're noticing a common theme, and this is why I love business credit. You can control so much that you cannot control with consumer credit scoring. So they're making a decision here, and they have a whole score that's based on whether or not you're going to fail and your business is going to fail. And it's really based on things you can control. Have you taken steps to get accounts that report to the business credit reporting agencies or not? If it's not, and you're newer, you're going to be high risk in a lot of categories. First of all, you're going to have a low INTELLISCORE because they have no payment history, but they have demographics. So they're going to give you a failing score right there. You're also going to have a bad stability risk score, okay, because financial stability risk score, because again, they don't know how many employees you have. They don't have your financial data. They don't have trade lines. So all of this indicates that you're high risk because, again, they don't have a bunch of information to tell them otherwise. But you can control it by, controlling the number of employees in the Secretary of State records, by giving them financial data instead of them not knowing how profitable exactly you are. By getting accounts that report to the reporting agencies, you can directly drive your scores up and be more lendable just by actually controlling these aspects that are 100% within your control, and be able to get a much higher score. So Experian's financial stability risk score, here it is broken down. Not a line on this means pretty much anything to you, but I found it and I thought it was interesting. So here we go, 96 to 100% shows the bad rate, 0.25%, and on. Percentage of bad debts excluded, score range. I won't even go through this, but the bottom line is that the higher the score, the lower risk you are. And here's the calculations that support that. The people that are coming in and that are a low score on this scale are 20 times more likely to have a bad payment rate than the people that are the higher score. So they know what they're doing. And guys, this is what I need you to know, is that the reporting agencies, all they do is gather and sell data, consumer and business alike. Their job is to gather data, come up with all these complicated compilations and calculations to determine if you're going to pay your bills or not, amongst many other things. So it all comes down in the business credit world, though, to how much data they have. Do they know the number of employees? Do they know the industry you're in? Do they have your financials? Do they have accounts reporting that show payment experiences? And if they don't have that, they start digging and start giving you low scores because their data reflects that your risk of default is higher. And guys, it kind of makes sense. It actually, statistically, it makes sense, because they're not going to know your number of employees if you've been in business less than a year. But if we look at business failure rates, the majority of businesses fail within the 1 to 3 years. The longer you're in business, the more likely it is they have your tax returns. They know your employees. They know these things. So that means that if they don't know this stuff about you, then more than likely you're newer in business, and that automatically means you're a higher risk at default. We all know that new startups have a higher risk of default. So it all really makes sense. The bottom line is, you know, and this is why I tell so many people, you can get money when you can't get money in a bank. Even as a startup, you just need to know how the stuff works and control it. You need to get them your employee data if you have a lot more employees than a startup would have. If you have good tax returns, send these guys your information so they can rate you higher as a result. Get trade lines reporting on your business credit reports. You can feed them what they need to be fed to give you a good score, knowing that if they don't have it, they're going to automatically punish you with a lower score. So Equifax, let's talk a little bit about them. So Equifax's main credit score is the credit risk score. This score was created to predict the probability of a business customer becoming seriously delinquent or 90 days within the last 12-month time period. Scores range from 1 to 100, with a lower score indicating a higher risk of serious delinquency. Similar to D&B's PAYDEX score. Now keep in mind, guys, all of these were the same, right? All of them depict the risk of 90 days late in the next 12 months. All three of the main credit scores that we looked at. INTELLISCORE with Experian, PAYDEX with D&B, and now we're looking at the credit risk score, which is the main one used from Equifax. And let me also jump in here, because I don't think this is on a slide. A lot of people ask about building credit with D&B and using D&B's Credit Builder. I love D&B's Credit Builder. I think it's a fantastic product. The ability to add accounts to your D&B credit report to get a score is invaluable if you don't know where to go to get initial credit accounts. Here's the problem. The problem is that the majority of banks are using Equifax to make lending decisions. The majority of credit issuers are using Experian to make lending decision. And the large part, it's because of D&B's Credit Builder. A lot of guys that used to use D&B for their main decisions started using Experian and Equifax the minute D&B gave a way for people to control their own score by adding their own accounts to the reports. So this is why, even if you use D&B's Credit Builder, which again I think is a great service, it only builds your credit with D&B. You've got to build your credit with Experian and Equifax, which D&B's Credit Builder can't help you do. And the reason for that is because the majority of credit issuers are looking at Experian. Means if you want a credit card, you better get your Experian score under control. If you want a bank loan, you better get your Equifax business credit score under control. Otherwise, you really face a serious risk of not getting approved for the loans and credit cards that you get when you go to apply, no matter how good your PAYDEX is. So similar to D&B PAYDEX, the credit score is based on payment history. All that's required for a good score is to pay your bills as agreed. The earlier the payments are made, the higher the score will be. So far, we've seen the same common theme. Equifax and D&B's PAYDEX are completely driven by payment history. You pay your bills earlier on time, you get a good score. Experian had 5 factors, but up to 85% of their score was based on payment history as well. So all 3 of them have this common theme that you pay your bills as agreed, you get a good score. Okay, so paid as agreed gives you a 90 plus. 1 to 30 days overdue is 80-89. Okay, 31 to 60 days is 60 to 79 score. 61 to 90 days overdue is a 40 to 59. 91 1 to 120 days overdue, 20 to 39 score, and 120 days overdue is a 1 to 19 score, okay? And another thing to keep in mind here, guys, is that Experian and Equifax, both of them can give you a low score even if you have no credit reporting. D&B is not that way. Remember, we talked about this. Now you know. D&B needs 3 trade accounts to report to get a score. Equifax and Experian, if they even have that demographic info, both of them will automatically give you a failing score even if you've never had an account report to them that's good or bad. So something very important to know. So Equifax also provides a business credit score for suppliers known as a small business credit risk score for suppliers. This model is designed to help credit grantors improve their risk assessment and reduce delinquency rates. The score utilizes unique bank loans, lease information, credit card and supplier info, utility info, public records, and that firmographic and demographic information that we talked about as well. And this score ranges from 101 to 816. So now Equifax, and I said Experian, Equifax also offers several other popular scores that are used by suppliers, lenders, vendors, and credit issuers. The credit risk score predicts the likelihood of you going 90 days late. We talked about that. The business failure score predicts the likelihood of you basically claiming bankruptcy or closing your doors. The payment index provides a dollar weighted. We talked about this with PAYDEX score. Dollar weighted, the higher the credit extended to you, the more weight it calculates into the score. A dollar weighted index of a business's current and past payment performance history based on all payment experiences. So there's a few other scores that you probably should know about as well. Again, the key is to get them financial data. The key is to be conscious that your employees tie into these other factors as well. And the key is, again, as always, to pay your bills as agreed. It's extremely important. So Equifax's business risk score predicts the likelihood that you're going to fail or claim bankruptcy in the next 12 months. And it identifies those that basically have a chance of going out of business completely. Okay, so FICO. Let's talk about FICO's business credit score. So far, we talked about the most common ones you're going to run into. Now, if you go to get a loan at your bank, you need to know this. So if you're even thinking about walking in your bank now or in the future, you need to know this because FICO's SBSS score is the most commonly used when it comes to getting SBA loans. So the FICO SBSS score is a measure of your small business credit's worthiness. The score is very popular with lenders and widely used by SBA, and this one does take into account your personal and your business credit. You can pretty much get high limit revolving credit cards for your business without your consumer credit ever being a factor. What do I mean here? I mean, you can get, you know, $10, $20, $30, $40, $50,000 credit cards at almost every major retailer. Name one. Macy's, you know, Sprint, BP, Chevron, Sears, Costco, Sunoco, Exxon, Apple, Dell, Walmart, Amazon. Almost every major retailer can get you a $10,000 to $50,000 limit revolving credit card account regardless of your consumer credit because they're going by these scores that don't take into account your consumer credit. You can also get car loans based strictly on your personal or your business credit quality. You can also get fleet credit cards, Visa cards, MasterCards you can use anywhere based completely on their business credit quality and not consumer. You start to get into bank loans, becomes a little bit more difficult because banks start to issue SBA loans and they pull this score, which takes into account consumer and business credit score. But don't worry, I'm going to show you how you can beat this score even if you have bad consumer credit bad consumer credit. And INTELLISCORE does have a variant too that could be used for that as well. So with the higher amount of loans you get into at conventional banks, the more your consumer credit possibly can come into play. So this was actually launched back in 1993, but in 2014, SBA started using this score for all loans under 350 grand, and this is when everybody paid attention to it. Like SBSS has been around since 93. Most people don't even know that. They're like, I never even knew FICO had a business credit score. Yep, they've had it for a long time, but it wasn't used. So what FICO did, because FICO's freaking brilliant, is they went to SBA and they got SBA to accept their score. And when they got SBA to accept their score and require their score, now all of a sudden they became really big on the radar as of 2014. Scores reflect the likelihood of you paying the bills on time, as all credit scores do. The scores range from 0 to 300. Okay, higher scores mean lower risk, so the higher score you have, the better. Personal and business credit history, as well as financial data, is used for score calculation. Okay, and as of 2014, all SBA loans require this. For SBA loans, you won't be approved with a score below 140. They typically set cutoff as high as 160. So let's talk about this. It's very important. You cannot get a 140 score if you have no business credit established with FICO SBSS. So let's say you have an 850 consumer credit score, the highest consumer credit score you can have. And let's say you don't have any credit established with Experian, D&B, and Equifax. They don't know you exist. They don't even have profiles populated. If that's the case, you cannot get a passing score with FICO SBSS, which means if you ever want to get an SBA loan, you have to build your business credit. It's impossible to get an SBA loan without established business credit, okay, because you can't get a score high enough. You can't get a 140 score without having business credit established, which is why you have to have established business credit to get a loan with SBA. Below that, you're going to be denied. As a matter of fact, a lot of lenders won't even submit your application to SBA if they know you have that low of a score, because they know that you're not going to get approved. So they won't even bother us submitting your credit profile or your application to SBA in that case. So many factors are taken into account to calculate this score. The owner or co-owner's personal credit, business credit history, age of business, years in business, financial data, including assets. So we see the same commonality. You can control your business credit history, age of business you can't, years in business you can't, financial data including assets, tax returns. If you have good ones, you could submit them and make sure that they get calculated, and you should, especially to D&B. If you do that, that's going to carry over here, as you're about to see. So the bottom line is, if you get accounts that report and pay your bills as agreed, and the better your financials are and tax returns that D&B has, the better the score can be. Cash flow, revenue, your 12 months of PAYDEX scores from D&B, judgments, liens, any other financial data, all this can be calculated into your FICO SBSS score. And I'm going to show you the most important part here, I think, probably in just a second. If you have no business credit and limited time in business, the highest possible FICO score is 140. But even to get that high of a score, you'd have to have a perfect credit history. So this is why I say you can't get a passing score with FICO SBSS to get an SBA loan with no business credit established. It's just impossible. The math doesn't work. Say SBSS models are validated for term loans, lines of credit, commercial loans, all the way up to $1 million. This helps credit issuers make evaluations for larger transactions. And if you're applying for bank financing for $1 million or below, chances are good they're going to pull your SBSS score. If you're applying for 350 and below, especially a conventional bank, yeah, pretty much 100% they're going to pull this FICO SBSS score. SBSS gives small business credit issuers different combinations of data to evaluate the risk for a business. This is very important. This is the most important part. So for example, a credit issuer can choose, I should have underlined, bolded, and red choose because it's very important here, can choose to only evaluate the application data of the principal owner, or they can choose to also include data from one or more of the business bureaus, or they can choose to weight one aspect higher than another. So what happens with FICO SBSS is that the credit issuer, the one that's requesting SBSS, can control what data they want to get. And then that will calculate and populate into the score sooner. And I'll explain this in just a second. So this is a highly intelligent score because it automatically goes from one business bureau to another in whatever order of priority the credit issuer uses to generate a score. Again, flippin' brilliant. What they actually do is they go to the lender and say, okay, Mr. Lender, what do you care about most? And Mr. Lender will usually say this: I care about D&B PAYDEX, I care about INTELLISCORE, I care about EQUIFAX'S risk score, and then I also care about the business owner's consumer credit history. And so then FICO goes to work and says, okay, we search D&B. Oh, D&B has no credit history. Let's go to Experian next. No credit history. Equifax credit history. Boom. consumer. So it filters through the priorities that the lender or credit issuer says that they want. If they say they want D&B score first, well, then D&B score populates heavier into the score than anything else. If they say they want EQUIFAX'S business credit score first, EQUIFAX'S score carries into the score heavier than anything else. Usually they're going to want D&B and Experian's INTELLISCORE and PAYDEX score primarily into this. Now, again, why does this matter? Because if you do what we've talked about so far, you can control it. If you're getting accounts that report to D&B, Equifax, and Experian, and you pay your bills, you automatically have good scores. And when they go through this cycle of looking at these, they see D&B, Experian, Equifax good scores, consumer scores not so good. You're still going to get a good score because the good business credit history way outweighs the consumer. The bottom line, when you're applying for a business loan, the lenders that are using FICO, SBSS almost always wait and request the business credit history first. The problem you get into is when you don't have any business credit history, then your consumer credit history heavily weighs into the overall score. So if you have some consumer credit issues, how do you get past them? Simple. You come in and you build your business credit, then FICO SBSS will look at the well-established business credit, weight it heavier than your consumer credit, and you can easily get past the fact that you in the FICO SBSS that you had those consumer credit issuers. So again, if a lender prefers D&B PAYDEX as the default, the SBSS pulls that info first. If there isn't enough data to generate a report, then it automatically checks another business credit score as Experian, then it moves to Equifax, then it moves to your consumer credit history. So good news all the way around to what we've talked about today, because what we've really discussed and dove into is how you can really control all aspects of all these scores. Congratulations, you just graduated. I mean, you now know how D&B's PAYDEX score works, Experian's INTELLISCORE, and Equifax's credit risk score. Okay, you now know that if you pay your bills as agreed, you're going to get good scores with the main reporting agencies. Those will carry over to your FICO and give you a good score there as well. You learned about some other ones too, and what you learned was that things like the age of your business, the size or employees, and what financial data they have is used to determine your risk. So if you have good tax returns, then get them to Dun & Bradstreet, get them to the reporting agency so they can give you higher scores in those other areas we talked about. Be conscious of the number of employees that you put on your Secretary of State records. Yes, it has tax ramifications as well. An accountant could better speak to that than I. But I will tell you that it also calculates here, as you saw, into many different aspects of the business credit scores, trying to determine your size. What you figured out here is that by getting accounts that report to D&B, Equifax, and Experian, you can get high scores and pretty much get almost any kind of revolving credit you want at stores, vendors, fleet sources, cash credit sources, and more. But if you want to escalate and get to a point where you want a bank loan, especially without a personal guarantee and credit check, you got some work to do, because employees matter, the financials matter. Other factors are tying into these additional scores that lenders are using, but now you know how they work and how to control them. So that wraps it up. I might hang around here for a few minutes to answer some questions that you have. Oh, spot on. How did I get through 57 slides in 1 hour? Awesome. If you have questions, let us know. 877-600-2487, info@creditsuite.com, 877-600-2487, info@creditsuite.com. If you have any questions, type them in. I'm going to hang out here for a bit and get them answered too. Does Seton still report on D&B, and how often? Seton does not, Lisa. Seton recently stopped reporting to Dun & Bradstreet as of, I don't know, 2 months ago, 3 months ago, something like that. So they no longer report to D&B. Guys, this is pretty common with vendors. Vendors come, vendors go. This is why if you look at my old videos from years ago on YouTube, you'll see I mention vendors you haven't heard me mention in years. And that's why, because they come and go. Sometimes they report, sometimes they don't. Seton might come back and start reporting again. But right now, Lisa, no, Seton does not report to D&B. So I can't tell you how often, because they don't actually report at all at this point. So I don't have any other questions coming in. If you do have any, go ahead and type them in. I want to reward you for coming to the live session question. So I try to make sure that I spend about 5-10 minutes answering questions if you have some. Does Wells Fargo? Yes, Wells Fargo does have a secured credit card that you can use that does report, but here's the problem. Wells Fargo requires a personal credit check. So you need a Wells Fargo. You need to have pretty good credit to get the Wells Fargo secure credit card. If you have good credit, do not, Greg or George, George, that was mean of me to call you Greg. George, do not go to get the Wells Fargo secure credit card if you have good credit. Talk to us and we'll give you some other options. creditsuite.com/get funding. creditsuite.com/get funding, no dash in between get funding. If you go there, you can fill out a quick, what's called a finance blueprint qualifier, and our finance team will call you. The reason I tell you is this. First of all, you can use other vendors like Uline, Quill, Monopolize Your Marketplace, Gimplers, those type of places to build business credit without a secured credit card. If you have good credit, instead of applying for a secure Wells Fargo credit card, there's other Visa, MasterCard, cash credit cards you can get with 0% rates that also report to the business reporting agency, and we can help you with that. So we can help you get non-secured, unsecured Visa, MasterCard credit cards that report to Amex as well, that report to D&B, Equifax, and Experian. These do require a personal guarantee and a credit check. But again, if you're going to go get the Wells Fargo secure credit card and give your social and give a personal guarantee anyways, well, then you might as well as go for unsecured versus secured if you can get approved. And if you can get approved for Wells Fargo secure card, you could probably get approved for unsecured options as well. We can help you with some of those options at creditsuite.com/get funding, so you know. I went in there and they had no clue what I was talking about. Yeah, and that's pretty common. George, what you're describing is very common with a lot of sources. You know, for example, we had a client that had to go through 5 layers of managers at Nordstrom for somebody to even know what they were talking about when it came to getting a credit card with no personal guarantee or personal credit check. They got approved, but they had to go through 5 levels of managers. So what you got to do is talk to somebody on their corporate side. If you go into Wells Fargo and talk to a personal banker, then a personal banker's probably not going to know. But if you talk to somebody on their corporate side or their business side, they will be able to better guide you. As a matter of fact, the person that knows of the Wells Fargo secure credit card that put it in our finance suite, she actually was one of the biggest bankers for Wells Fargo on the business side. So the commercial guys know, George. In a lot of cases, the consumer guys probably won't be able to help you. Does SupplyWorks report to any of the bureaus? Donnell, it's possible, but I don't know. I've never personally heard SupplyWorks does report. I'm not even really familiar with who they are. But again, it's possible that I don't know every single creditor that reports. So I've never heard of SupplyWorks reporting. That I'm not sure of. Does the Capital One Spark Card report to all the bureaus? Sure they do. Consumer. Stay away from Capital One Spark Card, Raheem, and anybody else, because Capital One Spark Card reports on your consumer credit reports, not your business credit reports. I've never seen it report to any business reporting agency, but it's the worst kind of business credit card you can get because it actually reports on your consumer credit reports instead of business. So that's one I recommend you stay away from. Hey, Ty, is it true that a business owner can pull cash out of fleet credit cards? Mark, I do not know. And I'll tell you why I don't know. Because I do live Periscope and Facebook streams, and multiple people have reported this to me that they have. They've told me the exact amount that they can pull out, the exact cards they're pulling money out of, but when we've went to those same credit issuers and tried to verify the information, they've told us it's not possible. So I'm in limbo on that. I don't know. I've never personally tried, so I can't give you a personal account. And again, we've had clients report that they have been successful, but we never verify that something is true unless the credit issuer will verify it for us. And we've never had one of them verify it for us, even though we call multiple times, talk to multiple people. But it's weird because we have clients come in with very specific information about how much cash they're able to pull out. So I don't think they're lying to me, and I don't think the credit issuers are lying either. So I don't really have the right answer because I've got mixed information on that. So I wish I could help you more than that. I can only tell you what I know. I'm going to sign up with Jim today. Cool. Oh, George, that's awesome. Jim will take good care of you. We've been talking the last week or so. Okay, cool. Thanks. Yeah, you know, George, that's the good part about working with us and working with Jim and our team is you don't have to guess this stuff. our team will give you access to a bunch of trade vendors where you don't need secured cards. If you're getting started with Jim and you do have the good credit to get the Wells Fargo, we can help you get the unsecured cards as well. And if you don't have good credit, no big deal. We'll introduce you to a bunch of unsecured trade vendors that will trade vendors, not vendor trade vendors, a bunch of unsecured trade vendors that will give you credit that report to the reporting agencies that aren't secured. So you don't have to lay a bunch of money down and go to your personal credit report if you don't want to. If you have an unsecured business credit card, then how do I add that to the business credit EIN? You don't. That's the answer, Sean. And a lot of people ask this question. So Sean, it's a really good question. And a lot of people ask and they say, hey, look, here's the deal. What if I have a credit card and I didn't find your stuff and I didn't know that you could even get credit that's linked to my EIN, and now I want to transfer it? Can it be done? No, it can't be done. Nobody's going to transfer that credit to your EIN. You just have to start over and start getting credit that reports to the EIN, and that's it. You can either get new credit that reports to the EIN or find like cash credit if you have good credit scores now that report. Either way. So the way business credit works, guys, is the key is to get accounts that report to the business credit reporting agencies, and they're secured ways. As George mentioned, you could get a secured card. There's also vendor trade vendors, like somebody's mentioned Seton here, or Uline and Quill. Seton used to report, they don't now, that report to the business credit reporting agencies as well. There's even options that if you're willing to give a personal guarantee and have good credit and willing to do a credit check up front, there's options there that will give you cash credit, Visa cards, MasterCards. You can even take all the cash out on that also report to the business reporting agencies. So there's multiple ways you could build business credit, multiple options, depending on, do you want a credit pull? Do you not want a credit pull? Do you, have good credit? Do you not? There's a lot of factors. You can get plenty of credit that reports to the reporting agencies that has no credit requirements, no credit check, or you can get stuff that does have a credit check that gives you a bunch of cash up front if you want to get it. So there's a bunch of different options there for each and about everybody. So but there's, unfortunately, Sean, there's no way to transfer cards from one to another. One's with a PG to no PG. So I'm going to wrap this up. Thank you all very much for hanging in there with us today and attending. Hopefully you got a lot of information you didn't have before you came in there, and hopefully I didn't keep it too dull. When we talk about credit scoring and mathematical rhythms and blah, 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 it could be dull. So I tried to give this to you in a format that it makes sense to you in actionable steps you could take to improve your scores to get the most amount of money to grow your business. So if you have any other questions, let us know. And no problem, Sean. Thank you for the thanks. info@creditsuite.com or 877-600-2487. Love the info. Lori, you can't see me, but right now I'm giving you a fist bump. Thank you so much for coming and hanging out with me for the hour. I appreciate it. I know how valuable your time is. Thanks, everybody, very much. Have a great day. If you have any questions, don't forget to grab your free guide, creditsuite.com/EIN. If you did have good credit, you do want to get those cash cards that also we talked about or I mentioned. That's creditsuite.com/get-funding. And feel free to reach out to us if you have any questions. 877-600-2487. Thanks, everybody. You're all awesome. I wish you the best as you're growing your business. Let us know what we can do to help you along the way. Have a great day, everybody. Thanks.